highs and lows of stock markets are often compared to a roller coaster ride. 1 minute you're on top of the world and making a profit, and the next it could all come crashing down and you start panic selling. Knowing how to keep our emotions in check while trading is an essential skill that investors need to learn, regardless of their experience. As legendary investor Warren Buffett once said, the most important quality for an investor is temperament, not intellect. So what strategies can we use to control our emotions while investing? Welcome to Pocketful of Dirhams. I'm Felicity Glover, the personal finance editor at The National. Joining me today is trading expert Matthew Carstens, Director of Product Experience at neo-broker Amana, who's here to talk about his best tips on how we can keep our emotions in check while trading. But before we begin, don't forget to subscribe to Pocketful of Dirhams on your favourite podcasting app. Welcome to Pocketful of Dirhams, Matt.
Thank you. Thanks for having me.
You're welcome. So tell me, what range of emotions do investors typically feel when trading? I mean, to me, it seems like it's a roller coaster depending on whether markets are up or down.
Well, that depends on if you're long or short, if it's up or down. But the range of emotions is honestly all of them. It's fear, anger, joy, excitement, probably even boredom if that's an emotion. So it is a roller coaster. So it really depends on like your plan at a time and where you're at with that and honestly how much risk you have on a position.
Absolutely. So I mean, from my experience, and I have to relate this to last year's bear market, it is difficult to keep negative emotions at bay, when markets are down. And the past month also hasn't been that great either. What strategies do you use to stay positive or to keep your emotions in check?
Yeah, I mean, one of it is, gets into leverage and risk size and things of that nature. But in general, just taking a step back, understanding, why are you in this position in the first place? So markets can be down, positions can be down, but did your thesis change yet or not? So if not, you're okay. If something material changed, then of course maybe it's time to reevaluate the situation. It really is taking a broader view and understanding where you're at in this position and what's going on in the world, and if something material changed. Also, honestly, be careful of social media. You got to be careful of that one because that one will really hijack your emotions.
Yeah, I was just going to say that herd mentality is not a very good attitude to have when you're trading or investing.
Yeah, correct. So it can be used as an advantage for you because obviously going against the herd creates some opportunities in the right situation. But in general, don't let it take over your brain, take over your body.
Yeah, no, absolutely. You've also said in an op-ed that we're running that you wrote recently for us that planning ahead and strategizing is one way to navigate the emotions while trading. Can you explain to our listeners how they can do that?
Yeah, sure. So there's a myriad of ways to plan a strategy. There's tactical analysis, there's fundamental analysis, there's everything in between. So really, it's like, what is your objective in this trade based on a certain strategy that you might have learned found anywhere on the internet, honestly. It really, from my opinion, is it really doesn't matter the strategy so much. It's more about the risk management behind it. So anything can kind of make money. I actually think of even like baseball players, like really good, like world-class baseball players are, they're right 3 out of 10. So don't get stuck into this, like I got to be right all the time. And that'll actually hurt you really bad. And so just understand, like, again, what is your objective? What are you willing to lose in a trade? Set that up ahead of time, plan that. If you know what you're willing to lose before you get in, so I'm willing to lose $100, but I'm willing to, I'm going for 300, or I'm willing to lose $1,000. I'm going to go for 3,000, something like that. You're already like preset your body to understand like what is the worst case scenario, so you can control kind of what happens next. It's not a surprise. You really never want surprises, or if there is a surprise, you can be prepared for it.
What sort of surprises could send our emotions plummeting downwards, do you think?
News events of any kind. It could be, if you're in a stock, a CEO steps down. It could be a merger. It could be a new government regulation. It could be an economic indicator that changes. It could be like things that you would never think of. COVID out of nowhere, right? So anything that changes the narrative, which always happens, you need to be prepared for. And so you need to have that in your plan that, hey, this is my thesis right now. This is where I think things are going. This is how much risk I'm willing to take in this position. But I know that everything can change and I need to be adaptive and kind of have a mandible mind as things move forward. So it kind of gets in the difference between investing and trading. But in general, know that things change and that you have to adapt to that, as long as you understand, like, what, again, stepping back and where am I at? Why am I in this to begin with? Does this news event actually materially like change that thesis? Or is it like a short-term anomaly that'll probably just, kind of roll over until the next news event comes out? And maybe I can use this as an opportunity to get in at a lower price, or not, or it is time to make a change.
Yeah. So I'm just thinking, we're talking about how news and events can influence various things. Can we flip back a little bit to say, a major black swan event, global financial crisis, Lehman Brothers? I mean, a lot of people panicked at that time and, sold everything and lost, pretty much everything that they'd invested. How would you suggest that traders, investors would react to a black swan event such as that?
I mean, you're human, so you're going to be scared and worried. Like, it's not like you don't think it's going to be superhuman and everything's okay. So it's very natural. It really gets into, are you diversified? What is your long-term plan? What is your goal? Again, if you take a step back and look at the long-term time horizon, in most cases, that's probably decades yet for investors, then this is going to be okay. If you're in equities, if you look at a long-term chart on equities, they go up and to the right. They're basically geared to do that. So I'm talking like generally and like diversifying in maybe like an index or an ETF or something like that, or even large cap stocks. So all just is understanding, again, like, where are you at? This is a material change. If I have my protection set, if I'm in a trade, then I'm going to be okay. I might take a ding, but I can be okay. I don't have to be in a trade. So I can get out. I can sit in my hands for a while until I can reevaluate the situation. That's a big one. You don't have to be in a trade. Like, a cash position is a position. And so if something really bad is going on in the world and nobody knows what's happening, that scares people and people take their money out. So there's stages of that. And so if you are able to get out in an earlier stage, if that makes sense, or if you have a stop loss that, took you out for a good reason because you planned for that ahead of time, then you'll be okay. And then you can, again, wait and find it maybe an opportunity that presents itself. That could be 30 minutes from that time. It could be, a week. It could be months, and sometimes even like a year or more. So that's okay. It's that pre-planning ahead of time and your time horizon in front of you of what's your objective and how do you get there.
Okay. So would you say it's a lot about emotional intelligence?
Oh, great question. I always say EQ is greater than IQ. That's like I love it. I think it's very much emotional intelligence is massive in trading, especially active trading, because it's like trading is like the ultimate game. It's constantly there to challenge you in every possible way. The market is, it's basically emotions on paper trading. That's when you're looking at a chart, right? And so you're in a crowd, and you're trying to, in one sense, outsmart the crowd, but in another sense, it's just trying to keep your wits and think about things in a way that is rational when maybe the market is not. So I definitely think EQ can completely EQ can protect you from getting completely hijacked in a trade. Where IQ, you can be the smartest person in the room, but if you're irrational, it doesn't matter. It's completely will wipe that out. But if you're not even a really good trader, but you have a plan to keep your emotions in check, I say that in jest a little bit, but you have good EQ, you can outperform the smartest person in the room. That's my opinion.
One of my favorite investors is Warren Buffett, and he once said the most important quality for an investor is temperament and not intellect. So I totally see where you're coming from with that EQ is much more important.
Yeah, that's great. I didn't know he said that. That's good.
Yeah, it's, I follow a lot of what he says. I try to follow what he says as well. Don't panic, remain calm, hold for the long term. It's not about,
Yeah, I was just going to say that guy, he knows how to hold for the long term. Like that's completely understanding what are you in, what is your plan, what is the long term thesis, and how much. He's definitely not in the trade for 3 months.
So this also, it also brings me to panic selling. Would panic selling be the worst case scenario when dealing with your emotions? When investing in equities.
I don't know. So in the financial markets, when you say things like worst than best, it's kind of an absolute. And we've been trained that there's never absolutes. So I don't know about worst, but I can tell you that you never want to be a forced seller. You never want to be forced to do anything. So it's way up there. If you're forced to do something, that's a very bad spot to be in. And that's a panic sell, right? So that's terrible. And usually that happens because you're fighting this ego in your head about being right. You change your trend line, everybody has the best trend line in the world. So my trend line is better than your trend line. So it's not about being right. You got to understand that. It's a big one. And don't be a forced seller.
Yeah, no, absolutely. And finally, what other tips do you have for investors to stay away from that emotional roller coaster ride when they're trading?
The first right off the top of my head, it would be don't use leverage. If you're starting out, do not use leverage. It's like a cocktail for disaster. And if you're right the first time and you make money the first time you trade with leverage, you better watch out because you're just training your body. It's like a sugar buzz, and you got to be really careful with that. So first tip, don't use leverage. In this day and age, you got fractional trading, especially with amana here. You can trade anything for like $5 and understand and get a plan and start developing a process. So, and then understand, are you here to trade to have fun or are you here to make money? Because those are two totally different things. So if you're here to make money, money is actually boring. You need a system and a plan and you need to stick to it. Sticking to it is very difficult. It takes a lot of time. It's into that EQ part too that we talked about. So just really understand if you want to have fun and make money, then set up two different accounts. One you're not going to play around with. It's boring and you're going to have a nice thesis. The other one you're going to enjoy and do the meme trades and all that kind of stuff. That's a different atmosphere. Just don't mix those. And let's see, I guess finally there's this adage in my head called the infinite game. I don't know who said this, but it's something about whatever you're doing, you need to understand it. Are you doing this? Is it going to allow you to continue? So is this trade that you're doing going to allow you to continue? If it's not, or it can blow up real easily, basically because you're trying to have fun or you're using really high leverage, you probably don't want to do it. It's hard as that is to do or to tell yourself, or you need to have really tight risk parameters because that little greed monkey in your head will creep in there sometime and blow out 6 months of hard work. So I guess those would be my tips. No leverage. Are you here to have fun or make money? And is what you're doing going to continue to play the game?
Thank you this week to Matthew Carstens from Neo Broker Amana. If you would like advice on your personal finance issues, you can write to me at pf@thenationalnews.com. And remember, PF stands for Personal Finance. Please do subscribe to Pocketful of Dirhams on your podcasting app to receive updates. And also leave us a review so we know what you think. This episode was produced by Eddyson and Doaa Farid. And I've been your host. Felicity Glover.